I have been searching for opportunities in the UK market for years. Today, I will reveal a stock that could be a prime purchase due to an overreaction by investors. In the last 5 years, this company has seen its revenue double to £1.5 billion. Free cash flow has increased by nearly 400% in the same time. It also appears that the business is becoming more efficient, with not only earnings going from negative to positive, but profit margins have also scaled at a faster pace than the revenue growth, reaching 7.9% in 2023. The KPIs also back this trend, with the return on capital employed increasing by 45% in the last 5 years, from 12.8% to 18.5%. Now, this is slightly below my ideal ROIC of 20%, but it is in my range of potential investments. The ROE, or return on equity, peaked in 2022 at 28%, although the fall to 26% is not a red flag when we look deeper at the balance sheet. This is because equity has grown by over 500% in the last 5 years. Now, I personally prefer a business that reinvests back into their own operations to achieve further growth. So the big increase in equity is actually due to the retained earnings, which fuels the increase in the book value of the company, hopefully helping propel the value of the shares. However, the debt levels have also increased by nearly 100% in the last 5 years, which could be of a concern. That said, when contrasted with that of the equity increase, it means that the debt to equity ratio has actually fallen by 68% to 113%, which is still slightly on the higher end, but is certainly acceptable. In the same time, the cash levels have quadrupled, but the cash levels do remain substantially lower than the overall debt position. In the last 5 years, this has driven a positive trend in which the net book value has increased. The balance sheet seems fantastic, but is this attractive enough for a value investor to jump in? Well, on a price to earnings basis, the stock is currently valued at 9.6 times 2023 earnings, which is very close to its 52-week low and less than half of its 52-week high. When contrasted with the UK market average of 11.4 times, this stock certainly looks cheap. Excluding pre-2020, the 3-year average price to earnings for this share is around 25 times. Was it perhaps overvalued in the last few years, or is it critically undervalued right now? The price to book ratio paints a similar picture, in which the ratio of 2.5 times barely floats above the 52-week low of 2.4 times. Its 3-year average is 5.3 times, again inferring that the stock looks cheap based on relative valuation. But what if this stock is a value trap? We should check to see if the management are aligned with shareholders to see that the shares should be moving in the right direction. At first glance, an investor might be turned off by the fact that this stock does not pay a dividend. Furthermore, the total share count has not reduced, suggesting that the management are not using capital to perform share buybacks. This might have been a concern if we hadn't already seen the large increase in retained earnings. Also, the consistent share count may imply that the management are disciplined in share-based compensation, but it might be at the expense of retaining top talent in the workplace. The quick ratio of 0.54 times indicates the company may struggle to pay its short-term liabilities if it were to face a financial crisis. However, the current ratio of 1.88 times appears to be good and suggests that the company does have enough current assets to pay down its current liabilities, which suggests to us that the business holds a very high level of inventory, which is reported to be at £356 million. Some investors might see this large inventory as a concern, as it suggests that the business is unable to shift its stock. However, in its 2023 annual report, half of the year-on-year increase is due to the new store openings, and the other half was due to an increase in like-for-like showroom inventory that supports the sales growth. There's the first hint. At the moment, the hot topic on the minds of investors is a potential recession, which means that consumer staple stocks are frequently mentioned in the media. This causes many consumer discretionary stocks to see a squeeze on their valuation multiples during harder economic times. As a contrarian investor, I like to go against the grain and believe that an opportunity could be present for those that are patient. This is a consumer discretionary stock. They're experiencing concerns over a major acquisition in the industry that could have a material impact on the sales of this business. However, this acquisition was to preserve a long-standing relationship between the two companies, as the owner of the acquired business is getting on in age and has no family successors. Notably, however, there's huge concerns that this acquisition will drastically impact the business model of this stock. This is because the acquiring business accounts for 50% of its total sales, and the acquisition means they could bypass this company entirely, which is certainly the biggest bear case for this investment. That said, the management has stated that this will not be a strategic move into retail by the acquirer, and there will be no change in the process of product allocation, which has been reviewed and confirmed by the highest level of management of the acquiring company. Insiders can sell for many reasons, but they'll only buy for one reason: to make money. Insiders of this company have bought £900,000 worth of stock in September using their own personal capital, suggesting that they are not concerned about the ongoing acquisition. If that's true, then this could be a great opportunity to buy when there's blood in the streets. From my discounted cash flow valuation, I believe shares to be worth around £5.54. The ticker symbol is WOSG and the name is Watches of Switzerland Group. Although maybe this stock isn't as oversold as you'd like. Is there another kind of stock that could have such great results? Well, yeah. Watch this video next to learn about the most dominant stock in the UK.